This is a download from BFM 89.9, the business station.
Good morning, George. Now, we've had some macroeconomic data come up from the US last week. Taking a bird's eye view of the data, what's your read of the US economy currently?
Good morning, Melissa. Well, our economy is going to continue to rev up in the coming months. We still believe that our GDP will increase around 2.6% this year, but obviously the sluggishness that we've had so far this year will probably have a greater impact. But from just a pure employee employment point of view, both big and small businesses are hiring at a rate of 200,000 plus a month. That will continue for the rest of the year, and by December, our unemployment will fall to 5.1%. We're seeing job openings being plentiful, and they are at their highest level in 13 years. We're seeing wages creeping up as employers are willing to pay more and will have to in order to keep skilled workers. Higher wages will restrict corporate profits. That will be the minus. The only concern we have is that productivity or not increases in productivity will not keep pace. But higher incomes on the other side will result in more consumer spending, as those who have held back on purchasing and have used that lower gas prices we've been having to reduce their debt will become more confident about the economy. So from an employment point of view, it's going to be positive going forward.
Well, last time this year, economic data releases were regularly beating analysts' forecasts, Dodge. What do you think this will mean for second quarter outlook? Do you think that the economy will snap out of this somewhat first quarter funk?
I don't think so. I think it's going to take a little bit longer. Some of the issues we have, our exports are going to continue to be hurt by the strong U.S. dollar. Imports will increase twice as fast, and there will be a widening gap, and it will take more of our GDP to make it up this year than it did last year. We also see a further narrowing of stock market breadth. There will be a pullback in the second quarter, but unless there's a major catastrophe, I think that will be viewed more as a buying opportunity as we get into the third quarter. One area we are going to watch, Melissa, is retail, because it has lost ground. The shares of major U.S. retailers lost ground this last week. April retail sales were poor, and there were mixed to poor quarterly reports. So that's one area we're going to have to watch.
And what does all of this mean for expectations of a rate rise by the Fed, Dodge?
It delays it. Our April retail sales, the industrial production reports, both were quite soft. That supports the belief that the Fed will not be raising rates this summer. The Atlanta Fed lowered its GDP and now is rolling the Q2 GDP forecast to 0.7% from 0.8% in response to the weak retail sales. We also saw University of Michigan Consumer Sentiment Index reflecting a rising inflation expectation. So we suspect that there will be a delay, but we still think the most probable date for a raise will be September.
Wonderful. And the bond market last week ended the week on a more stable tone. Still, I think more than $400 billion have been wiped off the value of global bonds this month. Are you expecting any more volatility in the bond market?
Yes, but maybe not as instantaneous as what we've been seeing. We continue to feel the probabilities are very high that our June contract in the U.S. bonds saw its high for the cycle in early April, and that the long-term trend is in moderately negative position now. However, from a very near-term point of view, after getting hit quite hard, as you were talking about, and becoming very oversold near-term, we feel that the June contract is held right above its support level and is now going to undergo a near-term rally in terms of price, and we feel it is likely to move up until it fails right around heavy overhead supply, around 8-9 points above. On the downside, we see some support, so we're seeing a trading range with an emphasis on the price of bonds solidifying and perhaps having a rally short term.
What about equities, Dodge? I mean, the S&P 500 climbed to a second straight record close on Friday. Are you expecting more upside?
Yes, it's still too early to be on the short side. There's a potential negative divergence on the NASDAQ as it moved over the short-term upside level of 50-50 on Friday, but then we can later in the session and close slightly below it. So we're going to see a further narrowing of stocks moving to the upside. We're still bullish on solar, many internet-related stocks, and there are several Chinese favorites that we continue to like. We still like financials, but they look like they're ready for a short-term correction. So what we suspect there won't be enough strength to really move out, and that perhaps will be helpful from a market point of view and a sentiment point of view, and it will prolong the length of the bull market.
And what else will you be watching out for in the week ahead, Dodge?
Well, we're watching for IPOs in the biotech and oil-related sectors. That continues to be a point of real interest. Our Secretary of State, John Kerry, is going to be visiting South Korea on Monday. That will be important. There are several earnings, mostly in Monday and Tuesday. In terms of economics, we are really looking more in the middle of the week. Existing home sales on Thursday are expected to be positive. There's some leading indicators that should be reported on Thursday. We'll be watching that. On Friday, the Bank of Japan ends its two-day meeting and will deliver its decision on monetary policy. That'll be interesting. Also, we'll be looking for the Consumer Price Index on Friday, probably to be flat after a 0.2% rise in March.
Always a pleasure speaking with you, Dodge. That was Dodge O'Dolan, Chairman and Chief Investment Officer of Lando and Fuse Capital Managers over in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.